Good afternoon and welcome to the NICHOLS PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Andrew Milne, CEO. Good afternoon to you, sir.
Good afternoon and a very warm welcome to the NICHOLS. Sorry, bear with me, there's a problem on the screen. Apologies. Good afternoon and a very warm welcome to our half-year interim presentation. With myself today, I also have David Taylor, who's our new interim CFO and has been with us 4 or 5 weeks, but has been CFO at Churchill China for over 30 years, so he's very experienced as they were on the AIM market as well. And behind me, Gary Eden, who's our Group Financial Controller and has been with us for 3 years. Okay, so the plan today is to make the presentation in 3 parts. So I will give you an upfront view of what's happened in the first half of the year from a strategic and an operational point of view. I will then hand over to David and Gary, who will cover the financial review with yourselves and give you a financial outlook. Then I will come back and just cover what our forward strategic focus will be and where the clear focus to drive growth in the future will come from. Okay, so I'll start with outlining the key highlights to take away from today's presentation. So first and foremost, we are really pleased to report that we have driven strong top-line growth of 6.6%, and in line with the strategic direction that we outlined back in March, that has been predominantly driven from our package business, both in the UK and internationally. Very encouragingly, our international package growth has had added momentum this first half, and our key 3 regions of the Middle East, Africa, and rest of the world have all seen strong double-digit growth. Both in the UK and abroad, we have continued to make strong accelerated investment in our exciting Vinto marketing campaigns, and that's very focused at driving growth, but also driving the long-term equity of the brands. Back in March, we signposted that we were facing significant inflationary headwinds of about 16%, and I'm pleased to be able to announce today that we have broadly mitigated all of those headwinds through a number of initiatives that we'll talk to in the presentation. Again, back in March, we shared with you the outputs of our out-of-home strategic review, and I'm really pleased to say that we've made strong progress on them in the first half. That will continue into the second half, and we'll start to see the full benefits of that programme realised as we go into 2024. Once again this year, we have maintained a very strong cash position that will give us firepower for the future. We have strong momentum on our ESG commitments, which are against 3 core pillars that we'll outline in the presentation. Again, I'm pleased to say that our interim dividend of 12.6 is progress on this time last year, in spite of the increase that we've seen from a corporation tax point of view. And finally, I'm really pleased to say that we are confident that our full year adjusted PBT will be in line with the expectations we have out there at the moment. Okay, what I'll do now is turn to give you a market update in terms of what's happening in soft drinks. So just as a reminder, I'm going to share with you the Nielsen data, which is the data that's used as the industry standard. But this takes the till roll EPOS data from the grocers. In the convenience wholesale channel, it is sample data, and doesn't include any of the mixed assortment discounters. This data also runs to the 17th of June, whereas our data runs to the end of June. So there are discrepancies. As you will see, our growth in the UK packaged at the half year is 4.5% growth, but this just gives some context and direction to where the market is going. So if we start with the UK performance for soft drinks in a whole, so I'm really pleased to say that the soft drinks market has again proved very resilient. You can see there that value growth is up 11% to that midpoint of June. And to give some context, it was 9% at the end of 22 and 7.5% this time last year. So really pleasing to say that's still going forward. But as you'll probably notice, volume is down 2.4%, so clearly being driven by price being taken. A couple of highlights to pull out. So energy, which is a 1.7 billion category now within soft drinks, about 15% of the total market, continues to perform very well, delivering value growth at over 15%, but also volume growth still coming through. A big change in the sports category, which has nearly doubled in size in the first half year, and that has been driven by the introduction of the Prime drink into the UK. And finally, to say the only subcategory that's not growing at the moment in the UK is mixers, as it struggled really to recover from the impacts of COVID. If we reflect on our own performance then, so we're pleased that in both squash and stills we are growing, but we have absolutely focused this year on a value over volume strategy. We do not have factories, we're asset light, so we don't have to be worried about overhead recovery. So we have chosen to compromise a little bit of market share in the short term to absolutely protect our gross margins as we have reduced our frequency and depth of promotions. However, I'm really pleased to say that within our squash portfolio, we are still firmly consolidated as the number 2 squash brand in the UK, and we are now enjoying 6 years of consecutive growth across that squash portfolio. Okay, so if we turn to what has been at the core of driving our package growth across our business in the first half, we'll start in the Middle East region. So I'm very pleased to say at the half year, we have driven sales by 17.5%, which is on the back of us celebrating our 100th year with Vimto and Ramadan in the region. On the back of that, we have had a very strong marketing campaign. You'll see from the first box there, outstanding in-store displays driving real strong availability and visibility for the brand throughout the whole region. We've had some milestone marketing campaigns, so we lit up the skies of Dubai with a light drone display that many people turned out to attend, and that was a real milestone event in the calendar over in the region to celebrate Vimto and Ramadan. We are in our 3rd year of our highly successful Sweet Togetherness campaign that not only focuses on driving brand engagement during the key Ramadan trading period, but has also allowed us to drive awareness of our brand new Zero Cordial range that has been launched in the region during Ramadan this year. Innovation has been key for us in our success in the last few years in the Middle East. And we have really successfully launched a new lime variant into our portfolio. And now what we see in the region is a much broader portfolio, giving us all year round incremental sales and complementing the key trading period of Ramadan when cordial sales will peak. Okay, if we turn our attention to Africa, again, a key region for us, and again, in the first half, we have driven 26% sales growth versus last year. At the heart of this success has been firstly the rollout with a new partner into the Ivory Coast, which is a country in the heartland of our strength in West Africa. It's a population of 25 million people, so a significant country, and it has proved very successful in the first half in fueling our growth. But equally important in some of our core markets where we still have headroom for growth, Senegal, Guinea and Cameroon have proved very successful, and that has been on the back of strong investment into below-the-line marketing campaigns, such as you see on the screen there, sponsorship of pop concerts, and also continued rollout of our impactful new branding to drive visibility and awareness of the brand. Okay, closer to home in our UK packaged business, at the core of our success this year has been the continued rollout of innovation. So we've brought new flavours into the marketplace and secured really strong listings with a number of retailers in the first half. We have as well launched into the very strong and growing energy category with a new proposition for Vimto. So we've launched 2 SKUs in a 500ml can format. Our proposition is it's a natural energy proposition with the caffeine coming from coffee beans. There are added B vitamins in the products, and the products are low calorie. The zero product having 20 calories per 500ml, and the non-zero product having only 90 calories. And both of these propositions have the great taste of Vimto. So we've launched this with an exclusive retailer in June. It's proved very successful. We've now had more retailers approach us to list the product, which we're rolling out in the second half. We continue to invest in strong on-pack promotions, such as the Big Cash giveaway and van sales to drive execution and visibility of our brands at the point of purchase, as you can see on the third box. And we also support that with our Find Your Different marketing campaign that's in its third year. And it's a fully integrated campaign, TV, video, digital and social. And we had a number of our ads in the middle of Love Island, which is bang on for our target consumer. We've also added some excitement and innovation to our carbonates category this year. We have Slush Puppy in our slush business, and we've now extended that range into our carbonates product in package. We've launched 4 SKUs exclusively with Asda during the first half, blue raspberry and strawberry in 2 litre and 500ml variants. That's proved highly successful, and we're having a full rollout of that across numerous customers in the second half. We signposted to you the outputs from our strategic review into out of home in March, which essentially was about a simplified business model, driving bottom line value, and running the business separately from our core business, so not to distract management attention. I'm really pleased with the progress we've made in the first half. We're on track to continue that in the second half, and then the benefits being realised as we move into 2024. As we exited COVID, we had a strategic focus in our business on making sure in our outsourced manufacturing model and logistics providers that we have the right foundations to provide the capacity and the capability to ensure we could realise our future growth ambitions. So I'm really pleased to say across our whole UK package business, we now have additional capacity to give us our strong foundations to grow. We have a number of tenders that we've taken out across all of our logistic providers in the UK and abroad, which is seeing real enhanced service levels come through for us currently. And we've invested strongly in putting a new in-house purchasing team in place now that will allow us to buy better for the future, but also with ESG in mind, to buy in the right way. And finally, from myself, we have made significant progress with our ESG commitments in the first half against the 3 key pillars that we focus on. I'm just going to pull out 2 elements to focus on today. So within our products we're proud of, just a reminder that the deposit return scheme, which was due to go live in Scotland in August this year, which is where there will be a 20% deposit put on aluminium, PET and glass, and then given back to the consumer when they put that product into a returnable vendor, has been delayed till October 2025, and that is in line with the rest of the UK. So we're working very closely in conjunction with the British Soft Drinks Association to ensure as we approach that deadline in a couple of years that the rollout is as smooth as it can be. The other point I would just ask to pull out really is the point around reformulation of our still slush portfolio. So back in 2018, when the sugar tax came into the UK, across the whole of the industry, the majority of slush manufacturers removed sugar from their portfolio and replaced it with glycerol. Glycerol is used in many food products today. and perform the function within the slush of stopping the slush freeze solidly, which is what sugar does in the slush product. However, in recent months, there have been a few issues across the whole industry where glycerol is consumed in large quantities, and as it dehydrates consumers, some younger consumers have suffered from nausea and vomiting. So as one of the key industry leaders, we moved quickly and decided to remove all of the glycerol from our still slush portfolio that is predominantly sold into play barns and trampoline parks, and replaced it with sugar. As a result of that, we have taken some one-off costs this year that we haven't exceptionalised and will be covered in the financial update in a few minutes. However, we do feel now we're in a very strong position as the FSA, the Food Standard Agency, last week launched communication that any slush drink now that contains glycerol will have a warning on to say not suitable for children that are 4 and under. Okay, thank you very much. I will now hand it over to David and Gary, who will take you through the financial numbers and then the financial outlook. Thank you.
Thank you, Andrew, and good afternoon, everybody. Before we go into detail of the slides, just a quick summary of the first half, which I guess you'd characterise the financial performance as being solid without being spectacular. I think a number of building blocks have been put in place for second half and into 2024, and the business addressed a number of challenges, not least the how to fairly and ethically put through an inflationary rise that covered off our increased costs without adversely impacting end consumers and customers. So but a very clear decision there just to focus on value rather than volume. Looking at the revenue slide, overall sales up 6.6% to 85.5 million. Going through the components of that, just to reiterate what Andrew said, packaged revenue up 10.4% to £64.5 million. Standout performance obviously from the international business, where it was up 24.6% with double-digit growth in all regions, obviously very strong in Africa, very strong in the rest of the world. I think the UK, we were pleased with the position we achieved, up 4.5%, very much protecting gross margins where we could, but in a sort of reasonably stable marketplace and some good progress there. The out-of-home business revenues were down 3.5%, and that does reflect the part of the restructuring process we embarked on, where we were going to withdraw from what we considered to be unprofitable customer accounts. Turning now to adjusted profit before tax. Good overall performance, up to £12.5 million profit in the first half from 11.3 million. That's a 9% increase. Clearly, some of that down to improved interest receipts, which we'll come back to later. But good overall performance, and the PBT margin moved up from 14% to 14.4%. Within that, gross margin was up £800,000 in absolute terms. The percentage margin was slightly down, but that reflected the decision really just to pass through increases in input cost inflation without putting an inflationary element on our gross profit. So there was a, if you like, a natural arithmetic effect, which despite the overall margin going up, the percentage margin was slightly down. Looking at volumes, international business was pretty well level. UK was slightly down as we sort of defended margin rather than market share, and out of home down with the restructuring. As I said before, underlying cost of goods inflation is about 16%. We did manage to mitigate that through one or two of the things we were working on already in terms of contract renegotiations with some of our co-packers and with other improvement projects. So some of that cost of goods was mitigated. Looking at the big cost lines, distribution costs £400,000 up, which is about 8%. That reflected entirely increased fuel costs in the first half against first half last year, and obviously that's now moderating. Admin costs up slightly by about 200,000, which is about a 1% year-on-year increase. A lot of that coming from increased payroll costs. We put through an average rise of about 5% in the first half year, but those costs were offset with some savings elsewhere. We have also increased our marketing spend in supporting the Vimto brand long term, and we expect that to be a little bit higher in the second half year. We're still committed to reinvesting some of the profit generation back into supporting the brand long term. And as I've mentioned before, interest income up £800,000 with increased interest rates on a pretty well maintained cash figure.
Okay.
Gary.
Thank you, David. I'd like to start by taking you through our new segmental reporting. As was discussed at the year-end presentation in March, we are now segmenting our business between packaged, out-of-home and central costs. This new segmental split will allow the group to manage out-of-home as a distinct division in order to maximise value, whilst allowing the necessary focus to drive the accelerated growth across our packaged business in the UK and internationally. David has already mentioned the revenue performance of our segments, so I'll focus on adjusted operating profit. Within our total package segment, the group is pleased to report an adjusted operating profit of 18 million, with growth of 1.5 million or 9% on the prior year. The strong return on sales of 27.9% demonstrates the potential within this segment. Despite the significant inflationary challenges previously mentioned, the group's value over volume strategy has performed well during the period, with margins broadly in line with that of prior year. Moving on to our out-of-home segment, our adjusted operating profit of 1.4 million is marginally down versus the prior year of 1.6 million. Within the current period, we've incurred 0.5 million of one-off reformulation costs. Excluding these costs, performance would have been ahead of the previous year by 0.3 million or 14%. The expected impact from the implementation of the out-of-home strategic review is to maximise value, enhance margin and drive bottom line growth within this segment. Therefore, we're pleased that our performance, once we exclude these one-off reformulation costs, would have returned a margin of circa 9%, up compared to the 7.5% in the previous period. Moving on to our central segment, which includes central payroll, head office overheads such as rent, rates, insurance, as well as governance and listed company costs, increased by 1 million on the prior year. This increase is principally related to payroll and staff related costs. The group's unadjusted profit before tax of 11.2 million was after an exceptional charge of 1.1 million as at the half year. During the period, the group has made significant progress on the implementation of the actions arising from the out-of-home strategic review. These actions have resulted in a charge of 0.6 million in the period and principally relate to restructuring and depot closure costs. Further work will be undertaken during H2 and more exceptional costs to be incurred. Work to implement a new ERP system, which is focused on driving business transformation, is now underway and is expected to be operational at the end of 2024 at the start of 2025. Working with a dedicated implementation partner, groups incurred 0.5 million of costs in the period. During the second half year, the group moves towards selecting its ERP solution and begins implementation during 2024, further exceptional costs will be incurred. Finally, the group has incurred some minor legal costs as it seeks to conclude on the recovery of debts from current and previous employees in relation to the historic incentive scheme. This is progressing well and in line with expectations. Moving on to net assets and capital employed. A principal KPI in this area is cash and cash equivalents. The group has maintained a strong cash balance at the half year, 56.1 million. The group is pleased to report a healthy EBITDA performance of 11.6 million, 13.5% of revenue. Working capital has marginally increased from the start of the year, as accelerated sales leading into the half year have resulted in an increase in the group's debtor balance. Remaining working capital has normalised and is broadly in line with the prior year end. Capital investment, which has historically been weighted towards our out-of-home business, continues to be a key focus for the group, particularly following our out-of-home strategic review. Total capex spend was 0.1 million at the half year, and whilst we expect increased spend in the second half, the group remains committed to managing its capital deployment closely. The group has seen a pleasing return on its cash deposits, following the rate rises at the tail end of last year and start of this year, with increased income received. Our return from capital employed of 25.9% at half year is up from 25.2% in the prior period. This shows good growth from future potential, particularly within our package business, which offers our highest return. Encouragingly, the group's pension surplus remains strong, with a surplus of 4.3 million at half year. Work to progress the pension surplus to a position for potential buyouts has commenced. I'll just pass back over to David.
Okay, thank you, Gary. Just looking quickly at the dividend, obviously the company's dividend policy is pretty standard at maintaining it at broadly 2 times cover. I think the slight disconnect really this first half between the increase in PBT of 9% and the increase in dividend of 1.6%. The reason for that is that corporation tax rates have increased from 19 to 25% with effect from April this year. So while we've delivered a much bigger pre-tax profit, more is going to corporation tax. So unfortunately, there's been a slight impact on the dividend, but the board's really pleased that it's been able to move it forward despite that. I think had corporation tax not moved, we'd have been looking at maybe a 0.8p higher dividend, but this is obviously something that really just affects this year rather than being ongoing. So, sorry, moving on to the financial outlook, just looking forward. I guess for business as a whole, very much more focused on a growth agenda going forward. That we've sorted out 1 or 2 problems within the business as a whole. We're a long way through the out-of-home strategic review, for example, and we do see steady growth coming from the UK package business going forward. We've got good momentum in the international business, and with good opportunities going forward, both in second half and in 2024. I think underpinning both those businesses, we do expect to spend a little bit more on marketing, but obviously with an eye on what the bottom line is. Out-of-home restructuring is proceeding well, and the forward investment path there is pretty clear that there won't be a lot of new investment back into out-of-home, and we still expect to secure the benefits that we identified, but largely within 2024 rather than in 2023. In the short term, the business continues to trade well. There is still some inflation risk, though I think, as I said earlier, most of our input cost inflation seems to be moderating. We're seeing a little bit in sugar, but in other areas, there's slight evidence of some costs coming down. So broadly, we're not seeing the same level of input cost inflation at all. Where we are slightly keeping a bit of a concerned eye is on the effect on the consumer of continued high cost of living costs. So just a little bit of caution there. As I said earlier, we do expect to spend a bit more on marketing in the second half, and maybe there'll be a bit more promotional support to push volumes forward in the UK. But overall, we're very confident in meeting forward market expectations.
Okay. Thank you, David. Thank you, Gary. So I will just come in now and just clarify our forward strategy and then sum up before we open the floor to questions. So 5 key areas of focus for us as a business. So absolutely, the focus will be on our package business and accelerating our growth as we've seen in the UK and international in the first half. That will continue at pace. We do have a strong balance sheet, so We do work closely to look at M&A opportunities. They will absolutely be in the packaged area and more than likely in the UK packaged business. So something we're monitoring closely and are looking to for in the future. As we've said, we will be maximising the value in our out-of-home business, keeping it simple and keeping our senior management focused on driving that packaged business. We will continue to implement the key initiatives, our operational change programme to maximise efficiency and also drive service. And we will deliver business transformation through the implementation of a new ERP system. We're working on that this year and into next year, with implementation likely taking place in early 2025. So to sum up today, we're really encouraged with that first half financial performance, good top line growth and then flowing through to the bottom line. Again, the diverse business model we have is proving pivotal to that success. Hopefully you can see we've got a clear strategic plan that is working. We do continue to be highly profitable and cash generative, and based on all of that, we're very confident that we can deliver our long-term objectives and continue to drive profitable growth. Okay, thank you for listening and thank you for dialing in today, and I think we're now going to open the floor to questions.
Andrew, David, Gary, thank you very much for your presentation. What I'll do is I'll just bring your cameras back up now. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few minutes to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions throughout today's presentation. And Andrew, perhaps if I could just hand over to you just to chair the Q&A by reading out the questions where appropriate to do so. I'll pick up from you at the end.
Okay, that's great. Thank you. Yeah, I'll read out a couple of the first questions. I'll perhaps take them and then hand over to David to take one. So, firstly, there's a question here asking around the competitive landscape in the UK market, and there's one question here particularly around Ribena. Are they becoming more assertive, and is that affecting Vimto at all? So yeah, I think it's fair to say, you know, Ribena are one of our key competitors, not only competitor, but one key competitor in the squash market. Yes, they are being more aggressive in terms of more advertising in the marketplace, and they do seem to have not put much price through in the first half. So that they have gained some market share within the UK in that first half. But we're very confident in our plans. As I said, you know, we are firmly consolidated as the number 2 player in the marketplace, and we are investing in the brand and having, you know, our 6-year consecutive growth. So very confident in the long-term health of the Vimto brand. Second question I'll ask, there's a few questions here around just how is out-of-home progressing, anything in the first half that will stop out-of-home progressing at the pace we want it to. And no, I think as we said in the presentation, really pleased with the progress we've made. We've implemented many of the actions in the first half, even though we've had to reformulate part of our at-home business on slush. We visited over 1,000 outlets to do that, but as well as doing that, our plan is firmly on track. That will continue into the second half, and as we said, we'll then start to realise the benefits in 2024. Okay, perhaps a question if I can ask of David, so I'll read this out. Would you consider a share split to increase liquidity in the shares? I guess this might benefit you as lack of liquidity might put off institutional investors.
Yeah, thanks, Andrew, and thanks, Mark, for submitting the question. I always think this is an interesting one because whenever you talk to our corporate finance advisors, they always suggest there's absolutely no reason why a share split should improve the performance of a share. But practically, there are always examples out there of it, and I think it is something that the board's got a bit of a session later on in the year thinking about things around shares, and it's certainly something that would come to the board. I wouldn't want to prejudge what the answer to that would be at this stage.
Thanks, David. Okay, got another question here. In terms of marketing, do you or would you consider using influencers? Prime is a great example of the potential impact. Yeah, I think for all of us who've been in soft drinks a long time, what's happened with Prime in the first 6 months of this year has been absolutely incredible. I've never seen growth like that before. It's quite unique, and to have people virtually bidding to buy bottles of the product. And we do use influencers on our brands, and will continue to do so. It's a real growing trend. But yeah, it'd be nice to find one that had the influence on a Prime, but my instinct is they are few and far between. But well done to them for being very successful with that. Let me just ask these questions as they're coming through. What is the plan for the 56 million cash on the balance sheet? As a second bit to that, what other international markets is Nichols trying to break into, or is it to go deeper into existing foreign markets? I think if I start with the international markets, then perhaps hand over to David to just answer about the cash. So yeah, I think it's clear for us that we're well established in the Middle East. We've been there, as it said, for 100 years, so that market is mature. But as you can see, even this year, we are starting to drive 17.5% growth through flavour innovation and focus on our execution in store. So still hedging there in mature markets. In Africa, in the continent there's about 50 countries. We're in about 27, 28 countries. So again, as we're seeing, we still see organic growth there, but absolutely we still see ourselves moving into other markets on the African continent, as the brand is very well known there. And there are a couple of markets further afield that we're just currently exploring, but it's about making sure that we focus our investment and our time on where we believe we can get the biggest returns, which probably in the short term will be Africa still. Okay, perhaps over to yourself, David, to just give a view on the plan for the £56 million worth of cash on the balance sheet.
Okay, well, dealing with the second question first, I think at present the majority of that 56 million is invested in short to medium term deposits with sort of strong financial institutions. So we do manage our cash sensibly. In terms of the forward-looking piece, I think clearly 56 million is a lot, and there's certainly some surplus there. I think at present we're looking at, as we always do, a couple of acquisitions. Mainly these would be focused on developing the UK package business. We think there are a number of new product areas that we could probably get into more efficiently through acquisition rather than through internal new product development. Certainly we could get to the position we want to quickly. So there is quite a big part of the 56 million is currently earmarked for M&A, but that is proceeding at a certain level. I think we're very clear as a business that we don't want to overpay for opportunity, that we want to be quite clear that anything that we buy sits alongside our overall strategy. So there's that there. I think I've not been with the business long, but one of the strengths of the Nichols business is that it is run prudently for the long term. So I don't think, for example, we would ever think about doing a really big acquisition or taking on debt to finance something. So there's always going to be some cash on the balance sheet. I think it is a matter of just working through the acquisition opportunities and then seeing what the surplus cash will be over and above that.
Okay, thanks, David. I'll just answer a couple more questions, then we'll need to wrap up. So there is one here about out of home, and do management believe that we will get the business to an acceptable profit level versus capital invested and management time. And yeah, absolutely, we did a really thorough review of our out-of-home business over about 12 to 15 months. As we get to the end of this year, we have a much more simplified business. As Gary pointed out, the margin without the one-off reformulation costs this year, the bottom line would be 9%. And we certainly believe we can get up to more like 10 to 12% as we get into next year. And therefore that, returns an acceptable level of profit to us. We're running the business very separately to the day business at the moment, so senior management time is not focused there, and that business still provides us with good cash as well to give us firepower for the future. There is one question here about some of the market share we've lost in the first half in the UK. As I highlighted in the presentation, that was absolutely our strategy. We were very focused on protecting our gross margins, so we've lost share by not promoting as deep or frequently. But as inflation softens, we'll be reinvesting that money back with our customers and then ultimately to our consumers by putting in place additional promotions and deeper promotions that we're very confident will recover that market share position. And perhaps just the last question before I do wrap up, there's a question here around, do we keep a pipeline of M&A targets? And absolutely, we work very closely with a partner who supports us. We are talking to lots of people in the last 12 to 18 months about M&A opportunities, and as David mentioned, we're still continuing to talk to a couple of opportunities for the future.
Perfect. Andrew, David, Gary, thank you very much for that. I think you've addressed those questions you can from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Andrew, could I just ask you for a few closing comments?
Yeah, thank you. So, just in summary, firstly, I'd like to say thank you for everybody for taking the time to dial in today. Thank you for all the questions as well. They're really helpful to us as well. And as I summed up earlier, to summarise, to say we're really pleased with our performance in the first half, both from a financial performance, but also in terms of our strategic focus. We believe we're firmly on track, making really strong progress, and really firmly believe and are confident in the future for the business and still being able to deliver our long-term profitable growth and objectives. Thank you.
Perfect. And thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of NICHOLS PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.